So as an extension to the yield curve dynamics, we have to understand yield curve theory. And there are basically three types of yield curves. One is upward sloping, all right? And actually the yield curve can shift out, it can shift back, it can flatten out, shift up, shift down, and it could actually invert, flatten, go normal. So the yield curve shifts and it moves dynamically up and down. And the Federal Reserve controls this. So what you're going to see is that the movement in the yield curves are going to go like this. They're going to shift up and down, and then they're going to invert and flatten. So they're extremely dynamic. And because of the dynamics of the yield curve, your cost of capital is changing constantly. So you have to be ready to issue the bonds or ready to issue the stocks at a moment's notice to take advantage of the low cost of capital. If all of a sudden the yield curves shift up or start to invert and it goes against you, you're out of the market. That's it. You can't issue any more stock, you can't issue any more debt, and the growth of your company is going to come to a halt. And if you finance your company with very high cost of debt and equity, and you don't get the returns on the assets, you're out of business. You're bankrupt and insolvent. Okay, so managing not only the liability side of the balance sheet is important, along with the asset side. So you got to be managing both. So the theory is an upward sloping curve is the expectations hypothesis using the Fisher equation. So as interest rates move up and down, it's basically driven by inflation expectations. Lenders, the buyers of the bond, want to be compensated for inflation. That's why it's upward sloping. And it's also called normal. It's a normal upward sloping yield curve. And this is the way it normally looks. There's also the market segmentation hypothesis that basically says that the bond market is segmented by short, medium, and long-term maturities. There's different supply-demand dynamics along the curve for each interest rate at each maturity. The market segmentation is also related to the preferred habitat theory that basically says that there are investors, lenders, there are borrowers, issuers, that prefer to be at certain segments along the curve. So corporations like to borrow short and invest long in most cases. But what they'll do is they will borrow short-term securities and finance inventory. So the life of the inventories are short-lived, so are the liabilities. So major corporations with manufacturing like to borrow on the short end. There are governments that like to borrow on the short end because it's cheaper, but they also like to borrow on the long end too, because usually what happens is that the inflation rate is actually higher than the expected inflation rate, which means that the value of the debt is actually shrinking. So they are able to monetize the debt, which is an illusion. Okay? So borrowers, corporations prefer to borrow at specific segments along the curve. Governments like to borrow on the long end. Corporations like to borrow on the short end. That's the preference. Lenders or investors prefer to lend the money based on liquidity and safety needs. So the higher the liquidity, the higher the safety, they're going to be in short-term bonds. But some investors want to match their asset life with their liabilities, such as pension plans. They want to invest in 20, 30-year bonds because they know that liabilities and their pensioners are going to be retiring in 20 and 30 years, and they need to match the maturity of the assets to liquidate to meet the liabilities that are going to come due based on their actuarial calculations. So you can see that the curve is upwardly normal in most cases, but this market segmentation and preferred habitat theory could actually cause the curve, as you can see over there, to hump, either in the middle or hump at the bottom. So you can get distorted yield curves based on the market segmentation preferred habitat theory, but in most cases, the yield curve is going to be upward sloping.